Investment banks. What are they? Businesses and individuals can use investment bank services to boost their wealth. Another name for investment banking is a branch that raises capital for governments or companies. Investment banking. What is it? The banking industry's investment banking division coordinates large, intricate financial transactions like mergers and initial public offering, IPO, underwriting. Underwriting the issuance of new securities for a corporation, municipality, or other institution is one of the many ways these banks can raise capital for businesses. They might oversee an IPO for a company. Investment banks also offer guidance on reorganizations, mergers, and acquisitions. Investment bankers are specialists who know the state of the investment market. They help their clients traverse the compound circle of high investment. Comprehending investment banking. Investment banks assist in selling securities, underwriting new debt and equity securities for corporations, facilitating trades for institutions and private investors, and mergers, acquisitions, and reorganizations. Investment banks also advise issuers on how to offer and position their stock. Goldman Sachs, Morgan Stanley, JP Morgan Chase, and Deutsche Bank are the most significant investment banking systems. Many of these systems are subsidiaries or affiliated with more prominent banking institutions and have gained widespread recognition. In general, investment banks support significant, intricate monetary transactions. If the customer of the investment banker is thinking about making an acquisition, they might offer guidance on the value of a company and the best way to structure a deal. Regulation and investment banking, a comprehensive overview. The Glass-Steagall Act passed in 1933 was a landmark response to the financial turmoil that followed the 1929 stock market crash. This legislation was designed to separate commercial and investment banking activities, as blending these functions was perceived as a significant factor that exacerbated the crisis. During the crash, many investors frantically withdrew funds from banks to cover margin calls and other financial obligations. However, numerous banks could not meet these demands since they had invested client deposits in the volatile stock market. Before Glass-Steagall, banks could channel retail depositors' funds into speculative ventures, such as equity market investments. Banks assumed more significant risks as these speculative operations became increasingly profitable, endangering depositors' savings. The repeal of Glass-Steagall and its impact. Despite its stabilizing effects, many in the financial sector viewed the Glass-Steagall Act as overly restrictive. In 1999, Congress repealed the act through the passage of the Gramm-Leach-Bliley Act, effectively eliminating the separation between commercial and investment banking. Since the repeal, major financial institutions have returned to conducting operations under a single entity. Investment banking in practice. To illustrate the role of investment banks, consider a scenario involving Pete's Paints Company, a paint and hardware supplier planning to go public. Pete approaches Jose, an investment banker at a major firm, to discuss an initial public offering, IPO. After negotiations, Jose agrees to purchase 100,000 shares at $24 each, totaling $2.4 million. This price is based on careful analysis by the bank's financial experts. Once the IPO is launched, the bank initially offers shares at $26 but struggles to sell more than 20% at that price. The bank lowers the price to $23 to offload the remaining shares. In the end, the bank earns $2.36 million from the IPO, resulting in a $40,000 loss due to an overvaluation of the stock. Investment banks often face stiff competition to secure IPO projects, which can pressure them into overpaying to win deals. Multiple banks typically collaborate to underwrite securities to mitigate this risk, sharing potential profits and risks. Key functions of investment banks. Investment banks play a critical role in complex financial transactions. Their services include underwriting debt and equity, assisting corporations in raising capital by issuing new securities. Advisory services, providing strategic mergers, acquisitions, and sales advice. Facilitation of transactions, managing the sale of securities and acting as intermediaries for trades involving institutions and private investors. Regulatory support, preparing necessary documentation for companies planning to go public in compliance with U.S. Securities and Exchange Commission (SEC) requirements. The role of investment bankers. Investment bankers are professionals who help corporations, governments, and other organizations plan and execute large financial projects. Their expertise saves clients time and money by detecting potential risks and devising strategies to mitigate them. With a finger on the thumb of selling trends, investment bankers provide tailored recommendations that align with the current economic landscape, guiding businesses toward optimal development strategies.